Welcome back to John Author's Note. The eurozone starts 2013 in one piece, which wasn't always certain last year. That's of course due to the European Central Bank, which took action in 2012 to preserve the integrity of Europe's monetary union. But there's still a lot to be done, which have to be discussed when it meets this week. High unemployment, low growth. What's the ECB going to do next? With me to discuss this is Julian Callow, who's the Chief International Economist at Barclays. Julian, welcome. Our first chart shows the success the ECB has had so far. What we're showing here is bank deposits in the eurozone periphery. What's this chart showing?
What we're doing here, Ralph, is showing the flows country by country for household and business sector deposits. And of course, you can see if we think back to the middle of last year, particularly to July, we were seeing some very significant outflows. This is Spain,
Greece,
yes, down around 16 billion there in July, and Italy down around 8 billion. And of course, the Greek numbers had been very weak at the time of the Greek elections in the second quarter of last year. But then we had a lot of attempts by politicians and by the ECB to try to build credibility.
Stop that fragmentation.
And stop the what people call the balkanization, of the banking sector. And particularly, of course, with the outright monetary transactions program that was launched in September. Yes, exactly. And then we see a very significant improvement. It's not fully consistent. There was a special factor here for Italy. I wouldn't worry about that.
So in other words, instead of the eurozone falling apart, it's now coming back together again.
We are seeing the deposits starting to grow in the periphery in southern Europe, which I think is actually very important, that the system is becoming more durable.
So catastrophe averted.
Yeah.
But the problem, of course, we have no growth. We have record unemployment, as we said. What can the ECB do to that? We look more at conventional measures, cutting interest rates.
Yes.
Our second chart is exactly what the ECB has done in terms of cutting interest rates.
Yes, well, the interesting thing is when people talk about will the ECB lower interest rates either this Thursday or later this year, attention is always around the main policy instrument.
That's the red one.
Which is the red line, the refinancing rate, the refi rate.
It could be cut a bit further.
It can be cut. But from the perspective of financial markets, what really matters is the overnight interest rate. Now, we've had a lot of ECB lending to the banking sector, so that's given a lot of excess reserves, a lot of excess liquidity, flooded the market with liquidity. And so if we look at the green line, the overnight deposit rate, EONIA, that is actually running at below 0.1% since December. And is effectively zero, very close to the floor that is represented by the deposit rate, which is the facility by which the ECB soaks up the excess liquidity in the system. So the point is, even if you cut the main policy rate, the refi rate, it doesn't really have that much impact on financial markets because they're all very focused on what the actual underlying overnight interest rate is.
The deposit rate, the floor, into negative territory. You can penalise banks for holding deposits.
You could
turn that negative.
We had Mr. Draghi at the last press conference in December saying that the ECB was operationally ready to have a negative deposit rate. But at the same time, you have to ask yourself, well, how is that going to be communicated by the ECB? How can it really explain having a negative interest rate? There are very few examples historically, I think, if any, of negative interest rates.
What matters, of course, will be for the ECB is outlook for inflation. Our final chart is actually the inflation rate, and what you've done here is the headline rate, which is the red line, around 2%, which is where it's supposed to be. But your point is the core inflation, that's excluding special factors, taxes, down by 1%. Scope for action there then?
Well, exactly. And certainly if you combine that with unemployment, it might suggest the ECB does need to do more. As you're saying, once you exclude the impact of indirect taxes as well as food and energy, you're dealing with core inflation that effectively is 1%. Now, if this was the Fed, I think the Fed would be going wholeheartedly into quantitative easing in a big way. But I think the ECB, of course, has more issues with undertaking a large-scale asset purchase program. And at the same time, I think the message that's coming from the ECB is that we've got to give the measures that have been undertaken so far more time to work, to permeate through. And in particular, they need to focus still on Southern Europe, where still we're finding that interest rates for small companies are very high.
Julian, thank you very much.
Okay.
So the case there for perhaps the ECB being as bold this year as it was last year, although listening to Julian, perhaps that's not likely just yet.